Hello, traders. I'm glad you're here. If you've been following the channel, you know my philosophy. We put risk first. We don't guess, and we certainly don't follow the herd. Lately, I've seen too many traders in our community, especially those of you protecting retirement capital, getting chopped up because you're using a 2024 playbook in a 2026 market. Here's the reality. Markets move in cycles. For the last few years, we've saw an unprecedented run in technology, driven largely by the AI boom. But trees don't grow to the sky. When a trade becomes too crowded, when everyone from the hedge fund manager to the taxi cab driver is long on the same three tech stocks, the risk to reward ratio flips upside down. In this video, I'm going to break down exactly why capital is flowing out of tech and into defensive sectors. But more importantly, I'm going to show you the technical footprints institutions leave behind, called supply and demand zones. This is how we identify where the big players are buying industrials and utilities before the news hits the wire. We're going to focus on the weekly and daily time frames because that is where the truth lives. By the end of this video, you will have a clear plan to rotate your focus and protect your gains. Let's look at the macro picture for 2026. You cannot trade in a vacuum. Right now, we're seeing a classic sector rotation. Why? Because valuation matters. For much of 2025, interest rates and hypes allowed tech companies to trade at massive multiples of their earnings. But as we settle into 2026, the market is sniffing out fair value. Research is showing us that the AI and mega cap tech cohorts are mathematically overvalued. They are priced for perfection. Any slight miss in earnings or any delay in product rollout results in massive corrections. We've seen this recently. Names that were darling, say 6 months ago, are now ripe for correction. This doesn't mean that AI is dead. It just means that the trade is crowded. The smart money is taking profits, and so should we. So, where is that profit going? It's going into the backbone of the economy. We're seeing significant inflows into industrials and materials and energy. Why? Because these sectors have been beaten down and ignored. They are trading below fair value. As expectations for rate cuts build, these interest rate sensitive sectors become incredibly attractive to institutional investors who need steady returns and not volatile moonshots. Think about it. If you're managing billions of dollars, you can't just sell Apple and keep the cash under a mattress. You have to put it somewhere. So you put it into companies that build things, companies that finance things, companies that keep the lights on. This is the defensive rotation. For us as retail traders, this is an opportunity, but only if we stop looking at the shiny objects that are and start looking at the boring ones. The boring trades are where the safety is at right now. The biggest enemy in your portfolio right now is the financial media. They are paid to keep you excited. They are paid to keep you clicking. They will talk about the AI revolution until the very last share is sold by the institutions to the retail public, you and me. This is the hype trap. For those of you like me, 45 to 65 plus, you know that capital preservation is the name of the game. You don't have 20 years to recover from a 50% drawdown because you bought the top of a hype cycle. Trading based on news headlines is reactive, it's emotional, and in 2026, quite frankly, it's dangerous. When you buy based on hype, you are usually buying into a supply zone. A supply zone is simply a price where institutional selling pressure exceeds buying pressure. It's where the big banks have decided this is too expensive, we are selling. When you buy there because a news anchor told you to, you are literally handing your money to a professional trader who is exiting their position. We need to flip the script. We need to be anti hype. We need to look for demand zones. In those undervalued sectors that we talked about, a demand zone is where price fell, paused, and then exploded upward. Those explosions tell us that institutions stepped in with massive buy orders. That is a footprint. They can hide their intentions in the news, but they cannot hide where their money goes on the charts. If we see a demand zone forming on a weekly chart or a daily chart for one of those defensive sectors, that is a high probability setup right now. It tells us that despite what the tech heavy NASDAQ is doing, smart money is accumulating shares right here. That is where we want to do business. We trade the chart and not the chatter. All right, let's get tactical here. I want you to pull up a weekly chart of XLI. Why a weekly chart? Because that filters out the noise. Then I want you to focus your attention right here at this pause area or consolidation area. Notice once price consolidated and buyers stepped in, we got an explosive move to the upside. This is evidence of the place that big money or institutions are interested in buying the industrials at this price. That, my friends, creates a demand zone and where you and I should be looking to go long or buy calls when price dips back to those levels. Now, here is the discipline part. We wait. We do not chase the price as it runs away. We wait for price to come back to our demand zone. In 2026, as money rotates out of tech, you will see tech stocks hitting supply zones overhead and getting rejected. At the same time, you will see the defensive areas like industrials pulling back into demand zones and finding support. This is the price plan profit method. We identify the zone, we set an alert, and we go live our lives. We don't stare at the screen all day. When the alert hits, we look for confirmation and we execute. Bottom line, you need to be ready. You need to know where you will be a buyer when price gets there. This approach removes the emotions. You're not worried about whether the Fed cuts rates in March or in June. You're looking at the chart. If price is in a weekly demand zone in a defensive sector, the probability is on your side. Or if price is in a weekly supply zone in a tech high flyer, the risk is against you. It is that simple. Do not try to force trades just because it worked in 2025. The market is different. You need to move on. Look for the fresh zones, levels that haven't been tested yet. That is where the strongest reactions happen. Now, a warning. Just because we have a demand zone does not mean we go all in. There is no such thing as a guaranteed trade. This is why I constantly preach about routine and risk control. You've seen my videos on my daily routine. I check the news. I know what to avoid. I know what not to trade. I check the economic calendar and I calculate my risk before I ever place a trade. In this rotation environment, volatility will remain high. The VIX is not sleeping. This means you must size your positions correctly. If you are wrong, and you will be wrong sometimes, it should be a scratch on your account, not a fatal wound. Your goal and my goal, especially if you're building towards or living in retirement, is consistency. It is better to catch a clean, calm 25% move in a defensive stock off of a weekly demand zone than to stress over a 30% whipsaw in a semiconductor stock, for instance. Boring is good, boring is profitable, and boring pays the bills. To summarize, right now we're seeing rotation. The easy tech money is gone. The smart money is moving into undervalued defensive sectors like materials, industrials, and energy. Why? Because they have been beaten down. Your job is to ignore the media hype. Switch to the weekly or daily charts. Identify the supply and the demand zones where institutions are doing business. If you want to master this specific strategy, how to draw the zones correctly, how to filter out the fake levels, and exactly where to place your stops, I, along with Trendy John, are going to be hosting an exclusive supply and demand masterclass coming up very soon, probably in March. We are going to teach exactly how we use supply and demand to beat the probabilities in the market and remain consistently profitable. So stay tuned for more information about that, and I'll see you in the next video.